In our presentation today, we're going to take a look at the question, how is your investment club doing during the current volatile markets, the threat of a recession, the down market, if not an outright bear market that we are seeing in the United States, and of course the after effects of the pandemic, which hopefully will be easing soon, but the opinions are definitely varied. This has certainly thrown a lot of investors and investment clubs for a loop. So I thought tonight we'd take a look at some of the recent activity of investment clubs, and we're also going to take some polls so we can get a feel for how you and your club members are navigating the current shocks to the market. So stick close to your computer. I'll give you about 30 seconds or so to vote in the polls and share your opinion. Then we'll share the results and we'll see how the investment clubs as a whole are performing. And we'll start right away with the question about what your club expects to do for its next scheduled meeting. So we're launching the poll. You've got a couple of options here. One is to reschedule it, to hold it online using online meeting tools. You may still be undecided, or hopefully you're holding out hope. Maybe your next meeting isn't until the end of May, and you're hoping to meet in person. I know a lot of people are expecting that even when the economy starts to open up and the shelter-in-place orders around the country are lifted, that many workers and many individuals are going to still be sticking pretty close to home for the foreseeable future, just to avoid any aftershocks from the pandemic and protect their health. So we'll give you another couple of minutes. I see 58% of you have voted, so we'll give it a couple more minutes for others to have cast your vote, and we'll see those results. All right, well, that's a minute, so let me go ahead and close the poll, and I will share the results. According to our attendees tonight, 77% of you are proceeding with your next club meeting and using online meeting tools, and I think that's great. I think that's a perfect way to get prepared for what may come with the market and make sure that all of your club members are on board. 17% are still undecided, 6% hopefully meeting in person, and 0% are rescheduling, and I think that's great. I think one of the important things for investment clubs to do during down markets and bear markets is to continue to meet, to keep things as normal as possible, to continue to be putting money into the portfolio, to take advantage of the low valuations, and to provide a bit of comfort and self-condolence to all of the members of your investment club. Well, let's go on now and talk about what clubs are doing. Are they buying, are they selling, or are they holding in the market? So I took a look at the anonymous data that we collect at myICLUB.com from the beginning of March through April 20th, so actually through yesterday, looking at the number of buys and sells each week by all of the clubs using the myICLUB tool. And so you can see the graph here over the last 6 weeks. The blue line are the buys and the orange line are the sells. So you can see that as things started to get a little treacherous around the second week of March, that both the buys and the sells started to decline. But also then you see at the end, the last week, the number of buys bounced back up pretty significantly. The number of sells increased slightly. Right in the middle, on March 23rd, that's roundabout, so this point on the graph is roundabout when the market hit its bottom. So the week going forward was very treacherous for a lot of investors, certainly coming down from the highs that were reached earlier in the year. There was a lot of increasing volatility and a lot of questions about what was going on with the market, and the feeling started to circulate pretty broadly that the coronavirus was likely to have an impact on the United States around the early March, and that certainly helped push the markets down. So this is interesting, but I think what the data doesn't show you on this graph that you can see on this graph is the ratio of club buys to sells for those same periods. So this is the same data fueling this graph, but you can see the week after the market bottomed, clubs bought 5 times, clubs made 5 times the number of buy orders than sell orders. And that's really kind of encouraging to me to see clubs recognizing that this is short term, it may be severe, but looking from a fundamental perspective, even with the uncertainty in the market, if you have a long-term perspective and you have confidence in the US economy and the companies that you own, that they will outperform over the 3 to 5 year period. And so taking advantage of pushing capital into those companies is probably a wise thing to do. And that's very contrary to what the rest of the market was doing during this period, which is dumping those stocks and trying to find alternative assets. But that's very tricky to do because there really aren't a whole lot of other places that you can get any sort of any semblance of return that you can get from equities. The average over this 6-week period is that clubs bought 3.5 times more than they sold. And you can see coming into March, the ratio was 2.8 to 2.7 for the first 3 weeks of March. And then after the last week of March, the 30th to April 5th, 3 times, the April 6th to the 12th, 2.9 times, and then the 13th to the 20th, 3.2 times. So clubs still have escalated their buying just a little bit. It certainly appears as we look at this right now. Again, this doesn't take into account replacements where a stock would have bought sold one stock and then immediately purchased another stock that they perceive to be a better value or a higher quality company. That kind of nets out. So this is really encouraging to me. I was very glad to have seen this bit of market information. And I think that the messaging that Better Investing has presented through the years, and certainly in the webinars I've done in our Investment Club webinar, last year, I talked about the coming bear market, and I've made a mission to try to prepare investors and investment clubs for the down markets because they ultimately will always return, and it's best to be prepared for them. And I think that savvy investment club members know a few things. One, that recessions and bear markets are temporary. They may be severe, there may be uncertainty, but they will resolve. And the market will resume its upward trajectory. As Warren Buffett says, it's good to be fearful when others are greedy and greedy when others are fearful. And I think this is a good opportunity when there's so much uncertainty and fear and anxiety in the market. We don't want to fuel that. We want to take advantage of the opportunities that are created by other people who have less enlightened perspectives on the long-term nature of the market. Savvy investment clubs know that quality companies will always perform well over time if purchased at reasonable prices. So when we're given the opportunity to buy shares at a bargain and we can take advantage of it, we will benefit from it. That time in the market is more important than timing the market. That we shouldn't be worried about trying to have sold stocks before the market decline. It's much better to keep your assets in the market working, especially in this recent decline where we saw the market fall. The S&P fell 35, 36%, and then came back more than 20%. And that's just a lot of volatility, and it's very easy to have gotten it wrong if you were trying to get out of the market before the decline and back in to benefit from the rise. That's just very difficult to do. So riding it out lets you see a net loss. As of last week, it was down about 19% for the year. That compares pretty closely to where we were in 2018, where the S&P 500 was down 16% for the year. So it's not uncommon to see this type of decline. Again, we expect a certain sideways direction of the market for the rest of 2020 for many companies. Still have probably 3+ months of losses, or won't have the revenue coming in to generate earnings for this first quarter, second quarter of the calendar year. So there is a lot of uncertainty, but we also know that there are companies that will perform well, and that there are companies that will recover faster. So we will look for those opportunities. And then finally, it's rational to hold during periods of market turmoil, and it's much better than many alternatives. So don't be fooled into thinking that, oh, some talking head on television or some free email that you subscribe to tried to tell you that you should have been able to read the signals, read the tea leaves, see the crystal ball that was forecasting the market decline, and sell all of your stocks in February, and then be ready to move back into the market when the recovery is firmly in place and the trends are. And this is just all hokum pokum from our perspective. And so letting the market decline and then resume its upward march is actually a risk management technique. And we play against the fear that other investors are letting drive their actions into creating opportunities for us. So those are some key takeaways that we can learn about so far. So our next question, I'm interested in what your club expects to do with its portfolio in the next 2 months. So your options are: buy more stocks if you can at low prices, sell stocks to increase your cash position, or are you expecting to sit tight until there is a little more certainty in the entire market? Those are the 3 options. I imagine there could be some other options, but if you might be expecting to sit for another month or so and then get back into the market, so just pick the choice that seems to fit your approach best. And hopefully your club has talked about this and is talking about this and does have a good consensus about how you're going to proceed in the entire as the market bounces around, and there are lots of opinions being shared. All right, so 69% have voted. We're up just about a minute, so we'll go ahead and close that. And again, good news there. 88% of you say you're looking to buy more good stocks if you can at low prices. So that's a good sign. Nobody is looking to increase your cash. Surprising. I guess nobody is tempted by those 0.2%, 0.3% interest rates on your cash counts at a bank, right? And 13% are sitting tight. And I think sitting tight is a fine strategy. I'm not the one to tell people what to do precisely. Holding steady is another way of looking at it, and I think that's a fine strategy, collecting some capital and wading back into the market as I've described it, instead of jumping back into new purchases. If you're concerned about the uncertainty, if your portfolio is causing you sleepless nights, there are ways that you can manage the risk a little bit and still take advantage of this particular market. So that's, I think those are some good things to think about. So as I looked at what clubs have been doing since March, and looked at especially what clubs have been doing since the market reached its bottom on March 23rd. And so I was able to find the 25 stocks that were the most purchased by clubs. So here are 1 to 12. And so I looked at both the number of outright clubs that were buying these stocks, as well as on the far right, the buy to sell ratio, because we always see, for instance, Apple is frequently near the top of our buy, sell, and hold lists for investment clubs. It's just a very popular stock, and some people will be cashing out or recording gains or selling for withdrawals or all different reasons. Other people are buying. It usually is one of the top 5 stocks in all 3 categories: buys, sells, and holds. So I looked at the buy to sell ratio over on which is on the far right as well. And surprisingly to me, but again, we can think about the themes behind these stocks, and I can almost imagine some of the discussion that went into them and why clubs decided to do them. But number 1 was Microsoft, and there were 39 buys and 1 sell since March 23rd. So that's very compelling. That's by far the most popular stock. Disney was second. Zoom Video Communications was third. This is the company that makes the meeting software that's very popular. A new company though. The current PE ratio of Zoom Video Communications is 1,552. I can practically hear Ralph Seeger rolling in his grave from Michigan at that PE ratio. Ralph used to say PE ratios above 25 or 30 not only discounted the future, they discounted the hereafter as well. So that is a big expected growth. Analysts looking at 33% annualized growth through the next 5 years. That PE ratio is just out of this world. Amazon, no surprise. Visa, Home Depot. Delta Airlines to me is a surprise, but maybe someone else can enlighten me. AbbVie, drug manufacturer, Google, Abbott Labs, Johnson & Johnson, Gilead Sciences, that rounding out the top 12 there. This graph, and you can see the data in your handout, has the sales, so you can see they're all very large companies except for Zoom. The trend of pre-tax, trend PTI and PTI rating, that's the percentage pre-tax income rating or the pre-tax profit margin rating or trend. So you can see plus is up consistently, minus is down slightly on the trend. So this is section 2A of your stock selection guide. Even is an even trend. Minus is a significant downtrend. And the PTI rating goes from 0 to 6, where 0 is terrible or no data available, and 6 is a consistent uptrend. So 3 is an even trend. So if anything below 3 is slightly negative to negative, anything above 3 is positive to significantly positive. The next columns are the percentage of the current price from the 52-week low and the 52-week high. So we look at some of these companies like Google is 16% down from its 52-week high, but it's 26% up from its 52-week low. So lots there. Abbott Labs is 55% above its 52-week low and down just 1.8% from its 52-week high. So some stocks have really gotten a boost, and some of the stocks on this list. Let me go on and go to look at stocks 13 to 25. So Stryker, 3M, Walmart, Aflac, Pfizer, Ulta Beauty, McDonald's, Alibaba Group, Bank of America, Costco, UPS, Bristol Myers Squibb, and Procter & Gamble. Probably all companies that you're familiar with, that you know a little bit about, probably not a whole lot of surprises why these companies are on a most active list at this point. So as we look again over on the right, you can see the buy to sell ratio and the number of clubs buying and the number of clubs selling each one of these stocks. We'll talk about them, but I was interested in knowing if your club members are increasing or decreasing their personal contributions to your investment club. So it may be that your club mandates a $50 dues and you can't contribute more. My position is that in a time like this, I would like to be putting a little bit more into my investment club each month to take advantage of the slightly reduced unit value, or perhaps significantly reduced unit value, in order to take advantage of it, give the club some capital to work with during this time. Other clubs, other people tend to stay away from the market when it's exceptionally volatile or when it's down. So 58% have voted, 59. All right, give it another couple of seconds rather. Okay, so that's 69% have voted, and 32% of you have club members who are increasing their amounts, and 63% are maintaining the same amount, and 5% say that you have club members who are decreasing their monthly contributions. Again, my recommendation is if your bylaws allow it, this is and you can afford it, this is a nice time to be putting more into your personal club account, your capital account, because assuming your unit value is down, when the market returns and your club's portfolio returns, you'll actually see a little bit of a bump up in your personal return in your club account. So this can be smart for you to take advantage of. So I wanted to talk about some observations about some of the companies and the ideas that were of the stocks that were most on the most active list in the last couple of weeks. Some are obviously, investors are looking at some companies as benefiting from or being in a stronger position rather than a weaker position due to the pandemic and the work from home and the shelter in place trends. For instance, Microsoft, Zoom, and Alphabet, that's Google, benefiting from a trend towards work from home. Microsoft, of course, makes the online office suite of tools, and so that is companies have a couple of ways of deploying their programs. Microsoft makes the tool suite that you can, as a company, you can subscribe to, and everyone can access the tools via web browser or via distributed networks, as opposed to installing the program on your computers. Google has a similar suite of tools, their Google Docs, and so those are seen as being the beneficiaries of trends where people are staying from home, along with Zoom. Disney, even though their amusement parks are closed, is benefiting because of their newly launched streaming service. I think the perception is that this is going to be a nice competitor to Netflix. Already has a lot of optimism about the number of people who are able to sign up for Disney streaming service, and as kids are spending all their time at home, this again could be an easy decision for a lot of families to subscribe and have quality entertainment going to keep everyone occupied. Certainly, as consumers are not going out to do their shopping, Amazon, UPS, and Alibaba, I would imagine, are benefiting from a trend towards shopping at home and having things delivered. And then everything related to health. Health and protection, AbbVie, Abbott Labs, Johnson & Johnson, Gilead, which has some treatments and vaccines in the works, Stryker, Pfizer, 3M, which immediately I thought I was trying to figure out 3M, and then of course it hit me with the personal protective equipment, the PPE, the masks, the gowns that 3M makes. That part of their business probably going gangbusters. Procter & Gamble, Bristol Myers Squibb, kind of rounding out that healthcare picks there, which are the most popular sector and industry. And then the stores that make stuff that you need, like Walmart, Costco, McDonald's, and Home Depot, I think are benefiting as well. Home Depot surprised me a little bit on the list, but as I sort of thought through, a lot of companies are working on building, putting in more uh, uh, architectural details to separate, the receptionist from people coming in with plexiglass or additional walls around cubicles, etc. So maybe Home Depot is benefiting from some of that. Maybe people who are staying home all day are going, all right, this is it. I'm finally going to finish the basement, and you can order your supplies from Home Depot, get them delivered. That could be part of it. Walmart and Costco, again, as people are staying at home instead of eating out, they're buying lots of groceries. Most of the grocery store chains that are publicly traded are local or regional rather than national, so they don't get quite the attention. But I would expect that many of the grocery store chains will have a good first quarter of the calendar year and those are defensive during a recession. Grocery stores are a good place to be because they don't see downturns in sales during difficult times. The question, of course, is that some of these companies get this big bump in the short term, but is that bump sustainable over the longer term? And then the jury is out on the long-term impact of this abrupt switch to working from home. Certainly, a lot of people are very tired of being at home every day with no or little social interaction outside of immediate family, and are really looking forward to getting back to work in the office. But on the other hand, maybe this is a little bit of the best of both worlds, as some companies might start staggering response in the workplace, so that half the workplace works half the week, the other half works the other week. So some people continue from home. Maybe companies will understand the benefit of working from home and having remote employees a little bit more and be more agreeable to doing it in the future. So that could still benefit some of the technology companies. Again, I mentioned Zoom's PE ratio, which I thought was because the company didn't have earnings. It does have earnings, and the PE ratio in our screening tool capped out at 1,000. When I actually looked at the data for Zoom and recognized that the PE ratio was 1,552, then that tells you everything you need to know about people who are buying not based on fundamentals, but on emotion. And maybe, again, this is great if you bought it and it went up quite a bit and you're protecting the downside with a trailing stop loss order, for instance, because the company simply can't grow fast enough to support that PE ratio anytime in the near future, in the next several years even. So that is something to be observed. Many of the stocks seem to be some good dividend payers: Delta, AbbVie, Pfizer, 3M, UPS, Gilead, Bank of America. But as I mentioned, many clubs seem to be ignoring the fundamentals. Companies like Zoom, Procter & Gamble, Abbott Labs, Delta, and 3M. Typically not. Zoom would be considered an emerging growth company. The others, not especially growth-centric these days, although the total return picture from a company like Abbott Labs can be attractive if you buy it at the right time. Certainly Abbott Labs and AbbVie have been covered in the investor advisory service. Delta Airlines surprises me because they're going to lose a whole lot of money in the first quarter. Yes, there may be some bailouts along the way, but that yield right now is 6%, and that is very much under threat. In my perspective, it's going to be hard to see how Delta and the other airlines can sustain those dividends in the face of massive losses. Some airlines I've seen around the world reporting first quarter earnings down 99% from last year. So maybe if they're able to eke out some money by furloughing workers and taking advantage of opportunities to sell planes, like some airlines have been selling planes to leasing companies. Those worry me. I don't understand Bank of America, the attraction of Bank of America. Visa, again, is covered by our investor advisory service, a high quality business, but the financial services stocks tend not to be the ones that perform very well during recessions as we go forward. I know Bank of America stands to make a lot of money from the fees for managing or mismanaging, as it were, the loan program that's supposed to help small businesses. And Bank of America had a first quarter where earnings were down, only down 50%. And when you think about the billions of dollars of revenues that it earns and all of the profits that it makes, that's, having earnings down 50% is enough to continue to pay all of the senior executive bonuses and still pay their dividend. Not a company that's under threat. So yes, I understand that. Visa, a little bit different. There are concerns about the consumer side of the economy. I would expect bankruptcies to go up and credit card defaults to increase, but that's not Visa's problem. So they're going to continue to benefit from the shop at home craze because you can't pay with cash perhaps. So you've got to pay with a credit card. So perhaps that's driving some of the interest in that particular company. And then 3M, again, it's just a very staid, mature growth company where there's just barely any growth to their business. They might get a little boost up, but I don't think that's sustainable. But I would like to, again, I would be happy to have someone give me their insights into why they think those particular clubs are interesting, and it might be useful for you to talk about some of them to your investment club, and you might come up with a different decision, have a different perspective, and that's entirely acceptable to me. Some resources for investment clubs. In last month in our webinar, I did cover some of the online meeting tools that are available for free or low cost. Since then, Better Investing clubs have Better Investing arranged with GoToMeeting for free licenses for member clubs to use for online club meetings. That's been very popular. It's been keeping Ann Cunhas busy arranging those. So if you are a Better Investing member club, you can contact Better Investing. You should have gotten an email a week or two ago about that program. The other thing is that as we look at your stock selection guides for 2020 and beyond, expecting earnings to be down this year and then recovering in 2021 at some point, it makes projecting earnings and revenue growth a little trickier. So I covered this in my Toolkit 6 webinar 2 weeks ago, where I talked about and demonstrated using an Excel spreadsheet to plot your earnings estimates for 2020 and 2021, if you have them, and then projecting your long-term growth rate from that point, and that will give you a figure that you can back into for the average growth rate over the next 5 years. So you can use that to project from 2019's fiscal year earnings going forward 5 years, and that will give you a ballpark earnings figure so you can build out your SSG models. So that is, if you go to the iClub YouTube channel, look in the Toolkit 6 webinar, you can see that video and find the link to download that Excel spreadsheet. And then I did a presentation at the end of March for Better Investing on investing in turbulent times. We actually broke GoToWebinar. It was the most viewed webinar in Better Investing's history. There were 1,100 people who came in and out of that webinar. The capacity is only 1,000. It crashed on my computer, but we recovered, completed the webinar. I re-recorded it the next day so that we'd have a nice clean version, and then we rescheduled it 2 more times for the people who couldn't get in and for Better Investing members only. So this webinar, I did it 4 times. The last time was a week and a half ago, and that is available on the Better Investing website. So if you are a member, you can see that video there where I talk about the history of bear markets and recession and pandemics, and give you a little bit of insight into navigating those markets. So those are just a couple more ideas that since our last club webinar that will help you perhaps with your club meetings and getting everyone on board. Next question, my poll tonight is, do some of your club members have problems focusing on the long term? Your options are yes, it's a struggle to keep everyone on the same page. No, your club is more or less unified in their approach, and it's only become a problem for us in the last month. It's always great if you can talk the talk, but walking the walk is a different story. So I got more emails and feedback from club members last month than I expected. The market is going down. It's down 12%. It's down 18%. Should we be selling stocks out of our portfolio? That's just not something that we ever really talk about. Selling in a declining market. Markets go up, markets go down. So we'd like to stay the course. So give you another couple of seconds to vote, and then we will close it out. And good news is that 75% of you say that your club is more or less unified in your approach to the investing. 19% say it's a struggle to keep everyone on board, and 6% say it's become a problem in the last couple of months. So that's a pretty good ratio. I know I see in the attendees tonight, there are a number of you who've been through more than a handful of bear markets, looking back at 2008, 2009, back to 2001, back to 1987's decline. We had a pretty massive correction in 1997, almost 10 years to the date after the epic 87 decline, and then going back before then. Bear markets are natural. This is the market's way of readjusting when it hits excesses, and so the good news is that the markets always come back. So maintaining that long-term approach is a good thing. So if we have any questions, we will, I'll take a look at them right now. George mentioned that he bought Zoom over the past 5 months at an average cost of $82. He put a trailing stop loss on it and sold at 135, but he won't do that again. That's, again, using a trailing stop loss in a case like that can be very prudent because you're really susceptible to a downturn. I know you want to participate in the upside, but you got to be careful of the downside for sure. Yeah, and so the question, a company like Zoom, let me flip over to my toolkit tonight, and so that you can understand what what I'm talking about when I talk about this company. So we've got 4 years worth of data going back to 2016. It went public in 2019. Sales last year were $622 million. Earnings were 9 cents last year, and they were 3 cents the year before. So that's a nice, robust, 300% increase in earnings. When you look at the historical earnings growth over the last 4 years, it's been 442% a year. Sales growing at 117% a year. According to the analysts that are tracked by Morningstar, the long-term growth rate that's expected from this year is from the present point is 33.7%. Typically, the way we talk about the stock selection guide is we cap earnings and revenue growth at 30%, and this is the problem. That's a massive slowdown from where things have been, and even at earnings of 33 cents in 5 years, we still have a situation where the P ratio, let's say it's 30 and 20, puts the justifiable price at $10, not $148. So this is just, it might be a great business. It might be the perfect stock to own at this time. It might be the perfect company to serve the needs of American businesses at this time. Zoom is not the only company in this space. Citrix is in the space with its WebEx program. LogMeIn has the GoToMeeting, which is similar to our GoToWebinar that we're using now. Google has its Google Hangout. Don't really focus on the business platform. So there are other competitors. I like the Citrix tool, the WebEx tool. It seems very robust and feature rich. It's also free for up to 100 people to meet with. So you know, I can see the potential there. So the bottom line for me is that Zoom might be a good company. It just doesn't fit our model. So if you are going to invest in a company like this, you need to be thinking about using stop losses, stop loss orders. You need to be thinking about isolating. You know, you don't want to put 40% of your portfolio in a company like this that might fall 80% in price. It's been, you know, it's more than doubled in the last 52 weeks. It was as low as 59, and now it's 148. So it had more than tripled at its highest point. So, you know, I could see a retrenchment coming back to the $60 or $70 point at some point, and that would be very painful. That as that P ratio would fall through the floor. So. Again, I'm not saying don't invest in it, but just know going into it what the risks are, so that you can take advantage of and plot your course accordingly. George asks, how can we know if Air Lease is collecting lease fees from the airlines during this time? Yeah, that's a good question. I haven't seen the Air Lease earnings release yet to take a look at it. I've seen their announcements. They are in good shape. Of course, if companies are not paying their leasing fees, then the planes get repossessed. If planes get repossessed, then the companies, you know, when they're back up and running, their newest planes, the ones that are the most fuel efficient, not that that matters with fuel prices being what they are going to be even more hindered. So I think there's a benefit from it. I think Air Lease has enough cash and to get them through. That's my analysis right now. But again, we're waiting for information on a lot of companies that will help us to make better decisions. And again, yes, go ahead, Russell.
On Air Lease, I had done some research. It's a bit 6 months old or more, but reading their, I think it was a 10K, that a lot of their leases have guarantees that even if they're not supposed to be, you know, if the company can't pay, there is a way for Air Lease to collect, either through some sort of guaranteed payments or through insurance. So I don't know how many of their contracts are that way, but from what I was reading, a fair number of them are. So they're probably going to get paid at least for a little while.
Well, thank you for that. Yeah, I expect it's going to be a tough year for any airline-related business, and we're just going to have to see how things pan out. But it's airlines and travel companies are going to be feeling it pretty bad, and how quickly they come back is anybody's guess at this point. I don't think anyone can make any sort of analysis. So again, if you're very patient and you have a true long-term perspective, there might be bargains. And you know, again, I'm a Delta frequent flyer, but I don't look to the stock as one that is particularly exciting for me. That doesn't fit into my portfolio. And I don't see really any airlines that fit my particular approach or objectives in my personal portfolio. All right, let's take a look. One last question. I'm interested in what you expect from the market for the rest of 2020. Do you think things will get worse before it gets better? You think we've seen the worst and it's all up from here? Or are things just too uncertain to really have any sort of inkling of what we can expect from the rest of this 2020 calendar year? Russell, feel free to chime in with your particular special
Oh,
opinion as well.
uh, I'm probably going to be going more for the too much uncertainty here. Um, I certainly don't think we've seen this, that the worst is probably over. I mean, I think there's probably a high possibility that we're going to get some worse news somewhere.
I think you're getting people to change their voting. I'm going to close it up now. So the 49%, pretty split. 49% thought the market will get worse before it gets better. 5% say we've probably seen the worst, and 46% agree with you. There's too much uncertainty to have any real idea about what we can expect. And again, that's fine. I agree. I think I'm in that camp because every time that I've made prognostications about the market, that seems to be the sign that things are going to do anything but what I expect. So there is a lot of uncertainty, and so that's why I think having a message of staying the course, holding steady, collecting information as it comes in, looking at companies from a rational long-term perspective, in light of this information is the smartest thing that you can do as an individual investor or investment club right now.
Yeah, my local BI chapter met and we were discussing this, and the consensus was really the market's going to go about news on the infection rates and how things are going and reaction to that. So, and there's not a whole lot of, terrible news or really good news on that. So
yeah. Well, the frustrating thing is that bad news comes in and the market goes up, and then good news comes in and the market goes down. And that because the good news was expected to have been better, and the bad news wasn't as bad as it could have been, and the debate is ongoing about how much uncertainty is already priced into the market. And the end of the day, nobody really knows. So all we can do is use our best judgment, use the tools that we have available, and continue to make the best investment decisions that we can with the information that we have. And don't get frustrated. Don't lose your any sleep over the market, the way the market's going, and keep your trust and hope in the long-term nature of equities. Over 10 and 20-year periods, equities deliver superior returns, and there's been no rolling 20-year period in the history of the stock market where investors haven't come out ahead. In 10-year periods, there are a few instances where the market doesn't perform. So the longer your perspective, of course, the better off, the better your chances of coming out with a positive result at the end of it. That's one of the graphs that I have, looks at the market since January of 2000. So that takes into account the bear markets of 2001 and 2008, 2009. And the S&P 500 is still up 95% over that 20-year period. And again, nobody is just sitting in the index for that period. So your actual returns, if you were an active stock investor during that time, would probably be a little bit higher than that, I would imagine. But it's certainly better return than you can get from bonds or even from dividend-paying stocks over that same period. Looking for growth is a smart strategy. Well, let's wrap it up. I want to thank you. Thanks, Russell, for your insight. Thanks in the back office. Thank you all for attending. We'll look forward to seeing you at our next club webinar. We were not scheduled for Tuesday, May 19th. because of the Better Investing Conference that was starting that week, but that conference has been canceled. It will not be a live event. So we may on the 19th. If not, we'll be back on June 16th. As always, please share your insights, your questions with me. My email's on the screen. I'd love to be able to address topics that you see as being most meaningful to you and your investment club members. So stay the course. We'll see you next time.